We're going to go back, we're going to broaden the scope a little bit, and we're going to take a longer term look at what the markets have done over the course of the past year. We're then going to take a look at this yield curve, this inverted yield curve, and I've got several different interesting charts to show you when it comes to this inverted yield curve. Hello everybody, I'm Dean Barber, founder and CEO of Barber Financial Group. Welcome to our monthly economic update. I am recording this update on September 11th, and our next update will be actually mid-October. Had a crazy schedule due to some family vacations and a little summer travel, so we'll be coming back to you mid-October. So let's get started by taking a quick look at the markets over the course of the past year. As you can see on this chart, here was the big drop last year. Now, there's a couple of indices that have not recovered at all. Those are the small cap, the Russell 2000 and the S&P 600 small cap indices. Both of those indices are still significantly down over the course of the last 12 months. And you can see most everything is just at about a break even over the course of the last 12 months. So it's been a rocky ride. This volatility that we've seen where I'm circling here, this volatility that we've seen here just in the last 2 or 3 months, it feels crazy again, but I wanted to go back and say, okay, here's what we were experiencing last year. And that volatility that we experienced last fall was far greater than what we've experienced here. Even if we take a 6-month snapshot of where we're at today, we see some positive numbers out there, but we still see some that are hovering around that zero number, 5%, on a 6-month basis. But you can see the volatility really start to show itself here. And the question is becoming, okay, what's causing all the volatility? Well, it's a number of different things right now. Some people are going to say, well, it's the trade war, dummy. It's what Trump's tweeting on a daily or a weekly or a minute-by-minute basis. It is the market trading on news. And I will agree that the news is manipulating the market. It's causing people to make quick decisions, sometimes emotional decisions and sometimes irrational decisions. But there's more to it. There's some fundamentals out there today that are causing the markets to feel a little bit uneasy. We started talking about this back in March when the 3-month Treasury started yielding higher than the 10-year Treasury. So I want to take a look real quick with you here at the Treasury yield curve. And so what we're seeing on this chart, let me start with September of 2017. So what you see here is that the short-term treasuries, the 1 month, were down here at 1%, and you kind of come out here, and the 10-year treasuries were yielding up here, close to 2.5%. And by the time we got to September of 2018, we noticed that this curve is a little bit more shallow. It's kind of flattening out a little bit, and so that's why last fall people started talking about the flattening of the yield curve. That's what you see here in the dark gray. So you see that the lower rates had come up substantially, and yet the 10-year rates had not come up nearly as substantially on a percentage basis as the short-term rates had. The blue line now is our current yield curve. So you see it's inverted. This means that everything on the short end out here is yielding more than the 5 and the 7, and in some cases even more than the 10-year Treasury. That is your inverted yield curve. So what does that really mean? I've got a chart here that shows that the 10-year to the 1-year spread on the Treasury has actually predicted every recession for the last 7 recessions. So here's what happens, and I'll draw this chart for you here. So if the blue line comes underneath the red, that means that the 1 year is yielding higher than the 10-year. So we saw it happen here. A few months later, recession comes. We saw it happen here. A few months later, recession comes. These shaded areas are recessions. Now, we saw it happen here, and it was several months before the recession came, and it was very, very brief. We saw it happen again here, another recession a few months later. Here we are again. This is the dot-com bubble, so you can see that the yield curve inverted back early part of 2000. The recession didn't really occur until 2001. And then we had an inversion here in 2006, and the recession didn't come until late 2008. So now we had the inversion. It's there again. And so there's a kind of a spread somewhere between 6 and 21 months after a yield curve inversion. For the last 7 recessions, there hasn't been a recession come. Now, this is not something that is absolute 100%. last 7 recessions have been predicted by this inverted yield curve. So we are, on the lookout here, and the markets are very uneasy about this. The markets don't want a recession, but please remember this. Every economic expansion is followed by an economic contraction. Every bull market is followed by a bear market. So with this yield curve inversion, that has the markets very, very, very jittery. And that's what's causing a lot of this volatility. And that's what's causing the markets to react so much more violently to the bits of news that are coming out of Trump's trade negotiations. Some will call it a trade war, Trump's tweets. Anything that's going on out there that could spook the markets a little bit, it's over-exaggerated because of what's going on with the underlying fundamentals. Now, one more chart here to leave you with this month. And this chart's a little bit busy, but basically what it's doing, this blue line is showing the stock market going all the way back into the 60s. And then the black line here is the 1-year treasury. The green line is the 10-year treasury. So again, this is just showing when the treasury yields on the 1-year eclipse the 10-year, the soon the recession follows. And the idea behind this chart is to show you what did the markets do during those recessionary periods. And you can see that in just about every single time you had some sort of pullback. Now, there have been periods where, like here in the early 90s, the markets had a little blip and just kind of ignored it. Obviously, the dot-com bubble was much worse. The Great Recession was much worse. And the volatility that we've seen here in the last several months, when you compare that to what we saw back in the dot-com bubble and back in the Great Recession, that volatility doesn't look so bad. This is what we want to try to make sure that we're really watching out for, is these, really what I would call devastating losses. So have your portfolios been more volatile in the last several months? Absolutely. There's no question about it. There's fundamental reasons behind it. But remember, the idea behind, good, solid wealth management is to make sure that you're protected, not just from daily, you're not protected from daily volatility. What we're trying to do is make sure that we protect you from catastrophic type losses like we saw back here in the dot-com bubble and losses like we saw during the Great Recession. You can't avoid the short-term volatility. That's pretty much impossible to do. And in fact, sometimes the short-term volatility causes a lot of indicators to really get whipped around. And so you have to have a lot of patience during times like this. We have made adjustments to many of our portfolios. Not all of our portfolios have had adjustments, but many of them have. I encourage you, as I do every single month, to keep the dialogue open with your advisor. Understand what your portfolios are doing. Understand what's in our head and what we're trying to accomplish overall, and how the portfolio construction that we have for you fits into your overall retirement plan. So keep the lines of communication open, and remember, the monthly economic update that we will do next month will come sometime around mid-October. Until then, I hope you have a wonderful day.